Are the monsters of Wall Street killing Mickey the mouse?
Oh, I don't know, guys. This stock is down nearly 50% this past year.
Yes, and it's even worse, I'd argue, over a 5-year time perspective, because over 5 years, it's down 20% and retouching the COVID lows. That is a bumpy and painful ride for investors. So the question is, what is going on with Disney stock? Is this a buying opportunity? How low does Disney stock go from here? If you enjoy educational investment videos, please make a point hitting that subscribe button. You are watching Unrivaled Investing. So let's understand what's going on with Disney. First of all, you see a management change up. Bob Iger coming back. Now, Bob Iger has been with Disney for something like 4 decades. He's overseen transformative acquisitions, Pixar, Marvel, Lucasfilms. Even though the sequels to Star Wars were awful, shareholders are still happy because they made a boatload of money. Smells like dark side to me. But still, looking at the business, Bob Iger, he's done some great things in the past. What he hasn't done well is come up with a good succession plan. And so that's part of the reason why they're in this problem in the first place, is that he kept on postponing, I'll be the CEO for another couple of years. And then, all the potential successors, they say, well, if he's going to keep doing this, I'm going to go, help run another company. So that's the problem that you've seen with Disney. And so, of course, he has to come back for another 2 years as CEO to help, clean things up, even though the fact is that he, sort of handpicked the current CEO that he's replacing, Bob Chapek. So, and he's talking about, hey, not only am I needing to come back in as CEO, helping run the business, but I'm having to restructure it. I'm going to have to cut some costs, try to get the, right the ship. And then even worse, Wall Street is saying, I personally view these types of headlines as noise. They're saying, well, wait a second, you made this big bet on the Avatar sequel, and you're starting to see softer than expected results, where this is a multi-hundred million, something like a $250 million budget, cost. And, if you're seeing weak box office figures, does this mean you're going to have some sort of write-off? And, I personally look at this as, when you see headlines like that, that's more noise than signal. That's more like, okay, you're going to have bumps in the road with businesses, especially a business as big as Disney that has a lot of different assets, all over the world, a lot of intellectual property. When you focus on one headline like this moving, $100 billion plus company, that's more of just a bump in the road, more of an opportunity to argue. But what you want to understand is what's actually going on sort of beneath that high level perspective. And so it is important to understand, well, what is Disney? Disney's really 2 separate businesses. You have their media entertainment and distribution business, and then you have their parks, experiences, and products, selling dolls and toys, another princess dress. And so looking at these, 2 separate businesses, they leverage each other. Obviously you create a movie and then you have a theme park ride. But looking at these businesses, you're really looking at 2 very different things. So with media and entertainment, you're looking at really not great results, 3% decline in revenue recently. You're looking at profitability get absolutely crushed. In the past year, you could see their profitability went from $7 billion to $4 billion in their media and entertainment distribution segment. So why is profitability, falling by 40%? And then you look at, their parks, experience, and products. That business was obviously hurt by COVID. And so it was all about getting back to capacity, because this is a business with high fixed costs. You get back to, you get your capacity utilization up to a high level, enough people going back to the parks, and your profitability explodes. So last year, their profitability was only $500 million for Disney parks, experiences, and products. This year, closer to $8 billion. Once again, that's driven by the fact that you have people coming back to the parks as, COVID eases or people feel more comfortable going out and about. So really a case of 2 different businesses, because the data points on parks and experiences continue to show real pricing power, real profitability. But this other story, looking at the media, entertainment, and distribution, that is more of a concern. And so it is important for investors to understand, okay, so you have these 2 businesses, one recovering $8 billion a year in, roughly operating income. This other business, which generates more of their revenue, that's falling apart. Why is that falling apart? Well, as you dive into the media and entertainment business, there's a lot of different pieces. There are the linear networks. So think about the cable companies where they're collecting fees. Think about broadcast advertising fees. That business is struggling, down 5%, only up 1% for the year, despite historically having very strong pricing power. So that business is struggling. That is their legacy and one of the largest components, roughly $30 billion in revenue. Then the next key aspect of why this business is absolutely getting hammered is because they've made this huge push on direct to consumer, saying, hey, this business model is changing. People aren't signing up with their direct TVs to go watch the Disney Channel. Now we are going to own the consumer relationship with Disney Plus and with ESPN and Hulu, and having specific apps that you're signing up for directly, owning that direct relationship. That process, though, is a real challenge for them because unlike the immense profitability that they've historically had with their linear networks, the cable, the satellite, the advertising businesses, the broadcasting, that they've had, the direct-to-consumer business is, much less profitable. You're looking at huge losses. It went from 1.7 billion in loss to 4 billion in loss with, adding all this content to get people to switch to Disney Plus app. So this is part of the reason why you're looking at their profitability in the most recent quarter dropped to effectively nothing and dropped by 40% during the last year. So yes, restructuring clearly in order, if they want to get back to historic profitability. So the question is, okay, so what happens to Disney stock from here? Does it just keep dropping? Do they potentially turn things around? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. Also recently launched 2 new investment courses for enterprising investors looking to learn about financial statements and analyzing and valuing stocks. In full disclosure, this is not financial advice. So looking at their linear business in greater detail, trying to understand, is this a temporary problem? Is this a structural problem? This is a structural problem, folks, because what they're seeing, first of all, historically affiliate fees, that's things where you have, keep in mind, the old system was very, you could argue it was messier. You'd have the cable companies, and the cable companies would raise prices each year. But part of the reason why the cable companies would raise prices each year was because the channels that they effectively paid for as part of their basket that they were selling to subscribers was their costs were going up. So the cable companies had to raise prices because the cost, which was Disney, ESPN, they were raising the prices as well, saying, hey, this is how much it costs. And that's what you see with the data, is that they're saying, oh yeah, here it is. Domestic channels saw a 6% increase from higher contractual rates, but this was offset by a 4% decrease from fewer subscribers. That's fewer, cable subscribers. And so that's the reason why this business is structurally challenged, is you can keep raising prices, but as long as that market is declining, where people are saying, hey, I'm cutting the cord, that is a real, very real problem for them. Then you layer on the fact that they also have this advertising business. Look at ABC, for example, broadcasting advertising down 12% because of fewer impressions at ABC, reflecting lower average viewership. So not only do you have the challenge with cable in terms of the affiliate fees they used to get from the cable companies, now you're also getting this lower ad impression because, hey, folks just don't find it as compelling. They're going direct to consumer. Now, this business model is arguably facing a challenge where they have to reinvent themselves. Disney has to reinvent themselves and say, hey, these historic price increases that we've done, that we've historically sort of sneakily passed to the cable companies, where people would be like, oh, I'm so angry at the cable companies, they keep raising prices. That was really Disney all this time, raising prices each year. And that's the reason why that direct TV bill got, sky high, or, your huge cable, pay TV costs just went bananas. Well, it's because their costs kept going higher. And so Disney's going to have to really retest their pricing power, but directly with the consumer. Say, hey, how much can we actually charge you? So that's the reason why they're saying, hey, let's front load with a ton of content on Disney Plus, get you on there where you say, wow, this is just tremendous. And by the way, this competes with, the Netflix of the world. And when you look at Disney now, they've actually have more subscribers than Netflix. So their investments arguably have been worthwhile. But the challenge is, where does it go from here? And how do you think about, Disney's valuation? Now, this is the reason why the stock has gone nowhere for the last 5 years. Disney currently has a $156 billion valuation. This chart shows historic free cash flow for Disney. And you can see at one point it was generating $9 to $10 billion in free cash flow, 2018, 2019. Cash cow. And it was growing, steadily growing over time. That's what investors love to see. And then you see now it's closer to $1 billion in free cash flow. This business has gotten absolutely crushed, partly because of, investments in parks, new rides. But the biggest part is the direct to consumer, just opening, launching as many new shows, grabbing the consumers. I look at this, and this is the big challenge with saying, hey, there's a fundamental bottom with Disney stock, is when you say, hey, there's $1 billion in free cash flow tied to this business, and you have a $156 billion market cap, that is a big discrepancy. So you're going to need if you think Disney stock, effectively recovers or starts plateauing at this point, stops declining, you're effectively saying, okay, I think free cash flow starts rebounding significantly in the years ahead, because 156 billion, if free cash flow just stays at 1 billion, let's say for the next few years, I'd argue you'd have a lot more downside with Disney stock, because let's say 1 billion in free cash flow, that could be like the equivalent of a $30 billion company or a $20 billion company. So this is clearly saying, hey, we're making these huge investments with direct to consumer, $4 billion, just huge losses there, investments in the parks. What's the normal free cash flow? And so if Wall Street thinks that if you think that Disney can get back to, let's say, closer to that legacy $10 billion, $11 billion in free cash flow, then you're saying, oh, this business trades at around 15 times free cash flow. And then it's like, okay, is that compelling? Right now, you're nowhere near there. And the challenge is that this business, as I've indicated, needs to reinvent itself. They need to say, hey, these legacy businesses, the affiliate fees, the broadcasting fees, those are going away. And the business that is growing is immensely unprofitable. That is a huge, huge challenge. And so maybe 15 times peak profitability is actually fair for a business that needs to overhaul itself, that needs to go through this reinvention. So I'd say, despite the fact that Bob Iger has overseen the company for decades, with the exception of the last few years, really, I mean, he was still, I think, executive chair. Still, the company wasn't really positioned to be in a state where they're generating tons of free cash flow. So this is a real problem that I think investors are going to need to deal with. So I think you could still have tremendous downside if investors think that it's going to take some time until their free cash flow recovers. So how low depends on the execution, depends on when do you think that free cash flow starts coming in. If that free cash flow were to come in today, $10 billion in free cash flow today or 3 years from now, then I think you see the stock stabilize. If you're talking about 1 to 5 billion in free cash flow for the next 3 to 5 years, then I think you still have huge downside risks. That's the concern looking at something like Disney stock, is that you're baking in a lot of assumptions on what does their free cash flow do in the years ahead. So another key aspect that I really don't like is that they have to retrain their customer. And that's going to be a real push and pull, because historically it was the cable company that was the bad guy. Now it's, oh, Mickey's raising prices this year, that type of challenge. And, will consumers directly stay? Will you face higher churn, something like Netflix faces every time they raise prices? That said, looking at Disney long term, I think the bulls could say, hey, they own this immensely valuable intellectual property. I've already called out, the Pixar, Marvel, Lucasfilms, even though what they've done with Star Wars is a disgrace, in my opinion, at least the sequels. So if you have this tremendous IP, you should figure a way to charge consumers enough to make the money. So that's sort of the bull case. But I look at this and think, $10 billion of free cash flow versus $10 billion in peak free cash flow, 10, 11 billion in peak free cash flow versus 156 billion. Like, I don't view that as like tremendous upside. Like, if you were to assume a 20 times multiple on, 10 billion free cash flow, then you're saying 200 billion. So you're really saying like, okay, 25% upside, 50% upside. So it's really that question of like, when do you believe they get to that free cash flow? And for me, that's just really too hard for me at this point. And that's part of the reason why you even bring Bob Iger back, is saying, hey, I got to cut costs and I got to figure out how to get the free cash flow there. When I look at my own personal investment portfolio, and I call this out to my subscribers at Unrivaled Investing, is I want to find the businesses that don't have to reinvent themselves. So for those that are speculating whether or not Warren Buffett or Berkshire Hathaway might get involved with Disney, I would be skeptical, because he's not looking for maybe he does some sort of speculative small bet, but until you start seeing the free cash flow really come in, and he's a cash flow type of investor, I think there is that some sort of skepticism, because this is a transformational challenge that they're facing. This is a reinvention of the business challenge. And I personally, when I'm, calling out ideas to my subscribers at Unrivaled Investing and saying, hey, this is, part of my portfolio, I want to own the things that are saying, hey, I'm confident this business model and their profitability and their margin structure is still the same, maybe even better 5 to 10 years from now. Whereas what's going on here with Disney, this is much harder, and you have to make assumptions about what, let's say, for example, their direct-to-consumer business looks like in 3 to 5 years from now. Even Netflix, which has, been running the direct-to-consumer business model for much longer, even they, don't have tremendous free cash flow. They might have, reasonable GAAP accounting, profitability, but they're not minting tons and tons of free cash flow. Only recently have they, started coming across as break-even, free cash flow. So I look at this business and I'm thinking Disney has some structural challenges. It's not high up on my, like, hey, I got to buy this. I would rather see something where it's like, oh, if I assumed peak free cash flow comes back in the next 5 to 10 years, and I'm penciling out 10 billion, maybe 15 billion, and I assume a 20 times multiple or maybe 25 times multiple, I would want to be able to say, oh, there's at least 100% upside. So if you're going to say, hey, this business should be valued, let's say at 250 billion someday, then I would want to have that, I'd want to have more of a discount than where it currently trades. Or if I'm going to say it has $200 billion value someday, so I'd want, $100 billion valuation today. So another third lower. So that's how I'm personally thinking about it. But once again, I would rather find the businesses that don't have to reinvent themselves, that are just growing and saying, hey, just put more gas on the fire and we'll just keep growing each year. We already have this existing profitability. So that's personally what I'm thinking about. If this video has been helpful for you, thinking about Disney stock, where does it go in the years ahead, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.